Module number 4, Access to Capital. In this module, we'll talk about debt versus equity financing, understanding and overcoming barriers around access to capital, strategies to obtain funding, and funding program resources to support your efforts. When thinking about barriers to entry for small businesses, one of the main barriers to entry is simply cash flow and access to capital. How will you acquire that capital that you need for your business? Where will you acquire it from? And what do they require in exchange for that capital? Now, the joke of the banking industry is you can get all of the money in the world from a bank. You can get all the money in the world as long as you don't need it. As long as you're already successful, already have capital behind you, and already proven out, they will lend to you hand over fist because you're not risky to them anymore. But the people that need the capital the most, the first-time small business owners or the business owners that have not made sales yet, it's more difficult for them to get that funding because they're risky to a bank at that point, or maybe an outside investor at that point. So we're going to talk about throughout this module in different ways you can access that capital. As discussed in the previous modules, you need to have a definitive answer to the question of exactly how much funding is required. Not a guesstimate, not an estimate. You need to know exactly how much money you need for those people, places, and things, as we discussed earlier, to get your business up and running. Knowing this answer will help inform you of which form of funding is most appropriate. There is no one size fits all. There's no classic case of this is the funding you should go after. There's nothing we can tell you in this course that is going to inform you exactly the decision you should make. Every situation's a little bit different and has different requirements and different considerations. Let's talk about bootstrapping. Bootstrapping is essentially using what you have already to begin your business venture, or being creative. For example, starting out with lightly used equipment instead of new equipment, sharing office space. These are all examples of ways you can bootstrap from the very beginning. Now, I know buying used equipment or lightly used equipment isn't the sexiest thing in the world for a first-time small business. You want to start out and get the latest and greatest, and that makes sense. But if it doesn't make sense for you funding-wise at the very beginning, it's okay to go with that lightly used equipment or used equipment to get started. It'll be very, very powerful for you if you can prove to an outside lender, investor, or potential business partner that you're going to ask for capital down the road. If you're already able to sell your product or your service with what you have on hand, and all you need from them is a capital injection to take you to the next level. Having sales and proving that you can sell your product yourself is very, very powerful when having those conversations, as opposed to just numbers on a piece of paper. So bootstrapping is one form of doing that. That could also be personal credit cards and bootstrapping and using what you have. But if you need outside investment or outside funding from an outside source, a popular way of going about that is called debt financing. And typically, debt financing is achieved through a lending institution, such as a bank or a credit union. The idea behind that is they give you a loan that is paid back in a specified amount of time with an interest rate in addition to the loan amount. So let's say, for example, you get a $100,000 loan for your business with a 9% interest rate or a 6% interest rate tacked on top of it. Next, we have equity financing. Equity financing is raising capital by selling shares in the company. Can you provide you connections and benefits aside from strictly capital? So think of this equity financing model as an outside investor, or if you've ever seen the TV show Shark Tank, think of it as this kind of model, equity financing model, where on Shark Tank, they go on the TV show, they pitch their product or their service, they get grilled by the sharks, and if they get offers for a percentage of their company for an amount. So let's say Mark Cuban offers $100,000 for 10% of their company. That would be an equity financing model. So he's simply taking away a percentage of their company or shares within their company directly in their startup or their startup small business. And with that, he also has benefits beyond the money, like access to suppliers, manufacturers, others in the industry, typical industry connections, or just general business mentorship. So while we all might not go on Shark Tank, there are outside investors outside of just that TV show. Now, I would like to make a small caveat here. While equity financing does get a large portion of what we see maybe on television or in news stories or TV shows made about these kinds of situations, in reality, equity financing for startup small businesses is only a small portion, about 10% of where startup small businesses get their funding. A large majority of startup first-time small business owners get their funding either by bootstrapping or debt financing, or maybe a combination of both. If you are going down the debt financing route when approaching lenders, don't forget about those local lending institutions close to you. If you already have a bank account somewhere, go in, talk to them, or call them up and talk to them about their business financing, what they currently do, what industries they mainly serve, all those kinds of questions you can ask your local lender. As mentioned earlier, banks and traditional lending institutions are generally looking to minimize their risk. So it is more risky for them to lend to a first-time small business owner that hasn't been proven out yet, or maybe a business owner that is an industry that is perceived risky. So what are they going to be looking at when you're looking for a business loan? Well, they're going to be considering the 5 C's, credit being the first one. If you have any business partners in your business plan, they're going to be looking at their credit as well. The question of business credit gets brought up a lot, and while you will want to have a separate bank account for your business at some point, and you'll want to start that as soon as possible, you don't have enough credit built up in that business account to keep that separate from your personal account at the very beginning. So they're going to be pulling your personal credit and your business partner's personal credit. Keep that in mind. That is an important point, because even if I have, let's say, for example, I'm going into business with a business partner, I have an exceptional credit score, and my business partner has a really bad credit score. Even though I'm doing everything right, if my business partner has a really low credit score, that's going to be a no-go. It's going to be a red flag for a traditional lender, and I won't get that funding that I need. Collateral. What do I have to put up against the loan? What personal property assets do I have to put up against the loan? Commitment. How committed to the loan am I? Have I done things like get registered with the Secretary of State? Have I opened up a business bank account? Have I filled out all of the information and all the paperwork they've been asking for? While these all might seem a little bit silly, and we shouldn't even be mentioning it because everybody should be doing that, it's here for a reason. Make sure you're committed to it. Make sure you're taking the proper steps and taking this process seriously. Character. If you have any defaulted loans or anything like that, that's what they're going to be looking at. Cash flow. What do your projections look like? And a lot of that is going to be built off market research if you have no sales currently, or a combination of market research and the current sales you already have. When approaching investors, typically, they'll be interested in what sets your business apart from the competition. So what do you have that is proprietary to your business and is different from people that are out there doing it already? What is the potential to exponentially grow with capital investment? And how can you back this up? So you need to be able to speak to your business in a way that makes sense to someone that has no idea what your industry is about and what sets you apart from the competition. Really quickly, going back really quick, when approaching lenders and approaching investors and local lending institutions, definitely, you want to think locally. For example, let's say this isn't to bag on national banks or large banks, but let's say there's a large banking institution that's national that you're looking to get a $100,000 bank loan from, and there's one credit union locally that is $100,000 you're looking to get that same bank loan from. Now, the national bank, they do large millions and millions of dollars of business lending all the time. So they're not to say that they're not going to be excited and they're not going to help you, but you may not get that personal touch that a local credit union or a local bank may be able to give you with that $100,000 loan. The local bank or the local credit union is more likely to give you that personal touch, answer the phone, answer questions when you have specific questions, so you don't feel like you're getting the runaround. So that's why we mentioned when thinking about lending institutions, when thinking about investors, search locally first, because they're more likely to have feet on the ground, boots on the ground, so to speak, and know the local landscape of what's going on. Now, let's talk about some resources. First up, funding resource, SBA loans or Small Business Administration loans. The idea behind SBA loans, they are loan packages meant to incentivize lending institutions to lend money to those who need it the most. So, like we discussed earlier, those first time small business owners. Before the SBA loan program existed, let's say 50 years ago, for example, or when it wasn't as readily available 50 years ago, if I was looking to start up my small business and I needed an influx of cash for big piece of equipment or a big piece of property, for example. And I was turned away from that bank because it was too risky at that point, or I wasn't proven out, or they didn't believe in the industry that people would shop there locally. I was kind of out of luck at that point if I couldn't get that funding from an outside source. I either had to go back to the drawing board, save up more money over time, or figure out something else to do. Whereas now, let's say I go to that traditional banking route and they tell me it's a risky industry. Well, I'm not necessarily turned away at that point. What they can do is refer me to the SBA as a lending resource for me. The idea behind SBA loans is a percentage of the loan is guaranteed by the SBA to the lending institution. So, what does that mean? Anywhere from 50% all the way up to 90% of whatever I'm asking for is backed and guaranteed by the Small Business Administration and the federal government. So, worst case scenario, if I go belly up and I move to Bora Bora in 2 weeks from now after getting my business loan and I change my name, the SBA and the federal government is going to pay back whatever percentage they guaranteed to that bank. That's the idea behind it. So it's less risky for that bank to lend to me at that point because they know no matter what, a percentage is going to be guaranteed to get paid back to them, whatever is guaranteed by the SBA. It should be noted that's only after approval from the SBA and the technical assistance from the SBA resource partners, which we'll discuss more in depth in module number 6. They are going to make sure I've got all my I's dotted, all my T's crossed, that my business plan makes sense through the resource partners. So you're not going to get around those 5 C's with the SBA loans. The idea is to incentivize small business owners who need that capital the most to not give up. For more information on the SBA programs available right now and all the different loan programs they have available, as it said on the previous slide, they go from large to small, all the way up from $500 on the low end, all the way up to $5.5 million on the high end. And there's a lot of different loan programs in between there. There's microloans, there's SBA 7A loans, there's SBA 504 loans for real estate. There's SBA Express program, which is meant to be a more expedited funding program through the SBA. There's a lot of different funding programs available right now. So go to that link, sba.gov, and just click on the funding programs tab. And you'll be able to find out all the information and all of the eligibility for everything I just mentioned there, among other programs. Another resource for you guys, the USDA. USDA has programs available specific to those in a rural area, meant to incentivize business creation and growth for underutilized rural areas. Various purposes for funding, such as modernizing facilities, converting facilities, business acquisition, startup costs, and anything you can really think of in between. There's the link for the USDA Rural Development Program's website, rd.usda.gov, and there'll be a programs tab on there, or you can just Google USDA programs. And very similar to the SBA programs we just described, it's going to have all the information. It's got a state by state box where you can enter your state and you can find all the programs available through the USDA within your state as far as eligibility, requirements, how to apply. It's very well laid out all on one page, so you don't have to go to 50 different websites trying to search out this information. So this module in summary, there's different strategies for approaching different sources of funding. Critically consider how much money you need, what people, places, and things you need, and which types of funding make the most sense for you. Or maybe it's a combination of everything we described. It's a combination of bootstrapping it yourself, SBA guaranteed loans, and maybe an outside investor or business partner as well to bring you benefits beyond the money. There's no limit, there's no right or wrong answer, but just know if you're seeking an outside investment, you're also going to need skin in the game from the very beginning. Now, what do I mean by that? You're going to have to pay some of it yourself. Typically, if you're talking about debt financing, they're going to want to see anywhere from 10% on the very low end, all the way up to 30% of whatever you're asking for, skin in the game from the very beginning from you. And that can be collateral, that can be from a lot of different funding resources that you have available, but they want to make sure that you're invested in your business first. So, as we said, critically consider how much money you need. Do you have the skin in the game, the 10 to 30% of whatever you're asking for to actually put in that pot to get your business up and running? If not, where are you going to get that funding from? No two situations are exactly the same. As we said in Module 1, consider your own goals before moving forward with any funding.